how to choose a PMS. Someone who's investing in a PMS for the very first time, what would be your advice to him on how to choose his investment performance, alpha, beta, whatever it is, the only thing, or is there more to it?
No, so I think first of all, when to choose a PMS is the person manning that product, or let's say who is the person behind that product. What is his track record? Those are two major important things. And when you interview or question the fund manager, basically you have to be in sync with how the fund manager thinks. And then you introspect that whether his thinking syncs with your temperament when it comes to investments.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, and on today's episode, I'm really thrilled to welcome a veteran of the stock markets, Manish Sonthalia, CIO, Emkay Investment Managers. We're going to talk about PMS AIFs and much more. Manish, welcome to Paisa Vaisa. Thank you so much for doing this for us. Second person from MK after Sachin Shah. Sachin was there, but you're the CIO, and as we were talking, 20 years at Moti.
Yeah.
And so you're a veteran of PMS and also AI, which is comparatively new.
Yeah.
I think you're the best person to tell our audience how have these two products, I think first PMS, evolved in these last, 5 years, probably 10 years and 20 years. Because if I'm not mistaken, PMS in India is actually quite old. The older ones would have started in the 90s.
Yeah.
AIF is relatively new. So just an overview of how both these products have evolved.
Yeah, so I think previously only PMS existed, and AIFs is a relatively newer phenomenon. But I think the need for PMSs as opposed to mutual funds arose when UHNIs and HNIs wanted a customized portfolio solution because of the differentiated needs and higher risk taking. All of these things were not in sync with what the mutual funds were doing. It was supposed to be a retail product where the ticket size is as low as 5,000 rupees, so on and so forth. So, that gave the need to a PMS, portfolio management solution services. It was basically a customized portfolio, tailor-made to the needs of that individual, that HNI. Subsequently, ticket sizes have moved up from 5 lakh rupees to 50 lakh rupees and, on its way to move even higher.
Yeah.
So, basically, it's an HNI product. Now, alternates, which is basically your AIFs, was a step to diversify the investment needs of UHNIs and HNIs. So, as opposed to just about, let's say, listed equities, there was a need by individuals and investors, HNI investors, that they wanted to invest in, let's say, real estate, or let's say commodity, or let's say private equity, or let's say hedge funds. Those were not within the purview of, let's say, what a mutual fund could have offered to you. That is how the need for, let's say, alternate investment vehicles arose. And these are two separate vehicles which are catering to the needs of sophisticated investors, seasoned investors. They are not meant for naive investors, early investors. No. They are meant for seasoned investors, those who have a higher risk-taking ability in their quest to achieve higher returns. That is the evolution of, let's say, an AIF and a PMS. I think the prominence of AIFs have broadly been seen post 2019.
Okay.
So, let's say 2019 to 2024, I think the corpus has grown from around 3 lakh crores to something like 11.5 lakh crores.
Wow, 4 times almost.
4 times.
Yeah.
So it has been growing at a much higher pace than what the mutual fund growth has been. PMS business has also grown at a healthy rate of between 15 and 20%. If I'm not mistaken, the corpus as we speak today is closer to around 8-9 lakh crores. Right? And so combined, I think there are certain projections that are made by institutions targeting some 100 lakh crores worth of AUM in the PMS AIF industry by 2030.
Yeah.
Given the pace of growth and the accumulation of savings by UHNIs, etc., I think this is the evolution. It's a product which is tailor-made for UHNIs.
Very interesting, right? Because the mutual fund industry, I think, is about maybe 60-70 lakh crores.
Yeah.
Again, projected to be 100 at some point of time. PMS and AIF combined is about 20, say 11 and 11.
Yeah.
I say 10 years ago, 20 years ago, this would not even have existed. This now it's become at a 3x size, 20 and 60 or 70, whatever the number is. How has the product evolved? Like, let's take out AI, because AI, I think the most popular category
3.
would be Cat 3,
Yeah.
okay, which is meant for a very specific audience. Let's just stay with PMS for a while. Like, when this industry started in the 90s or even in the early 2000s when you
yeah.
had joined, what was it like then and what is it like now? Like today, for example, a lot of seasoned fund managers of an era
Yeah.
have moved out of public mutual funds and started their own PMSs. So,
Yeah.
how has that evolved?
So I would believe that the basic need is moving away from a Janta product, which is basically a mutual. Obviously, you're dealing with a larger number of folios, etc., to a group of investors trying to fulfill a certain need. And I think there exists a solution for each product. And at the end of the day, a fund is as good as the fund manager. Whatever structure you may choose, whether it is an AIF, Cat 3. We are not talking about Cat 1 and Cat 2. Those are private equities and venture capital.
Correct.
Another set of investment solutions to be made. But let's say when you compare with, let's say, a mutual fund and a PMS and an AIF, except for the taxation benefit which is there for mutual funds, the PMS and are different structures. Only thing is that PMS, the investor wants to be more hands-on, more active involvement in the day-to-day happening of, that is the only difference.
Sure.
And in AIF Cat 3, it may be somewhat more passive, where you have ceded control to the fund manager.
Correct.
That is the only difference. But at the end of the day, a fund is as good as the fund manager. The person manning the fund, because he is responsible to generate performance, whether it is through a full transparency, as in the case of a PMS, or in the case of a AIF Cat 3, whether it is through a NAV, net asset value. That is the only difference, I would believe.
Okay, now I want to get to the other side of the table, which is the clients.
Yeah.
Okay, HNIs and ultra HNIs. How have conversations evolved? Like 20 years ago when you were at Motilal or when you were doing the PMS business there for them versus now when you're at MK. You think the quality of questions has changed? Like people want to know more. Obviously the base of people has increased a lot, right? Because India has progressed, HNIs have grown, ultra HNIs have grown. So the number has increased, which is fine. But are people looking at PMS in a different way, or it is just, कि भाई जो चलता है वो बिकता है?
No, it is not like that. See, people have become more financially literate. And the wealth of HNIs have grown exponentially. So one aspect is truly there, and this in the case of, let's say, family offices getting set, etc., is to have unlisted equities in their portfolio.
Okay.
And this comes within the purview of your AIFs. So, AIFs were unlisted, or let's say private equity, and a lot of wealth has got created when companies are basically bought in the pre-IPO AIFs, or let's say even the unlisted private equity AIF. And when it gets listed, bulk of the value capture happens in that vehicle.
And it makes sense because, the Zomato, Swiggy, Policy Bazaar,
Dixons
Paytms, all of them.
You create a bulk of the value when the company is unlisted. That is not to say that when the company gets listed, there is a hindrance to the value capture. They're still there. But I think this lure of making multifold returns, particularly for the UHNIs, you have a lot of wealth to invest. And when you are talking about, let's say, debt not serving the needs of even inflation beating, then obviously within the equity space, there is a shift away not only for listed equities, but also a preference for unlisted equities. That is the basic shift in the last 2 decades. That's one. Second, when the environment for alternates began in early 2000, when I entered that industry, and obviously it existed 10 years before that, but there were very few number of players. When I joined Motilal, there were hardly a handful of, you had a Motilal, you had an ASK, you had an INAM, plus a few of them. That's about it, 10 in all, having 90% of the corpus.
Out of which, I think the real veteran fund managers would be someone like Bharat Bhai sitting at
Bharat
ASK.
Bhai, Motilal, Ramdev ji out here. But today you have 500 PMS managers. So basically, there are no entry barriers in this business. Survival of the fittest. The demands of investors remain the same. They want relative performance. They want absolute performance at all points in time in the top quartile.
I wish it was that easy.
But it's that tough.
Yeah.
So competition has increased manifold, leading to a lot of undercutting on fees and so on and so forth. All of these things have happened, but I think that's the basic difference between, let's say, decades ago, what the alternates business was, and but I think at the end of the day, this industry is becoming even more efficient. Survival of the fittest. There you create an edge. A lot of choices. You have micro cap managers, you have small cap managers, you have mid cap managers, multi cap, unlisted, every thematic, all of them. That's basically an availability. All these choices were not available back then.
Yeah. The point on costs is very interesting that you're saying whether it is fees or profit share or whatever model that a PMS follows. I was just interested in knowing that what's happened in the mutual fund industry is you had two models emerge, direct versus regular, which gave an opportunity for retail investors to choose how to lower their costs and therefore increase their return. And second was active and passive. Is passive anywhere in PMS? I mean, I would assume that if anybody wants to do passive, then go to mutual fund.
I think if anybody wants to come to alternates,
just to reduce the cost, like you were saying.
No, it's not only about, first of all, between the mutual funds and the alternates industry, there is so much of competition. There is not a single player who can charge even a paisa extra.
Wow, okay. So market is really efficient.
Really efficient, and everybody is clamoring for AUM.
Okay.
That's there. Second, basically, what was the second question you asked?
So second question was passives. What I said was that one is cost structure. Yeah. But you can't compete on that.
No, but
like
passives is not the prerogative of what alternates are.
Okay.
People come to alternates to have superior alpha.
Okay, fine.
Through stock picking.
Right?
First of all, within the alternate space, there is a greater focus on what you select to buy.
Okay.
As opposed to benchmarking your index or hugging the benchmark. So that's and in a mutual fund, it's more about, let's say, plus minus something about the index. Because you are competing with 42 mutual funds, all have the same. Plus you have SEBI restrictions, top 100 large cap, 100 to 250.
Here there is no restriction of that sort. Now that we've discussed so much on the past, let's look at the future. Where do you think this product is going in terms of its form and shape? Like, how can PMS evolve from here? Like, if you look at the same product 20 years ago, it's the same as it is today. Jada kuch change nahi, except maybe for entry ticket size. It used to be, like you said, 5 lakhs. Today it's whatever, 50. Tomorrow will become 1. Jo bhi hai. Anything else? You think the product will evolve, or will more strategies emerge, or anything?
Yeah, so I think there are some areas where this needs to be, somewhat changes need to come into the PMS industry. First of all, there should be a level playing field between the AIFs and the mutual funds and the PMS.
Okay.
For one, PMS can't invest in IPOs.
Oh, okay. And AIF can do unlisted.
AIF can do unlisted, PMS can't even do unlisted.
Mutual fund can do IPO.
Mutual fund can do IPOs. AIFs, Cat 3 can also do IPOs.
Oh, very interesting.
But PMSs can't do IPOs. So if you are talking about a level playing field in terms of investable securities, then PMS should also be allowed to invest in IPOs.
Sure.
At the pool level, right? Because AIFs and mutual funds can invest in the QIP category, which is institutional buyers.
Yeah, correct.
Here in the PMS, if you were to apply on an individual basis, then you have to apply in the HNI category.
Yeah.
So the amount to be allocated is lesser than when you, let's say, have. And there are great IPOs which come at fabulous valuation, the benefit of which actually goes to, let's say, the mutual fund or the AIF. That is one.
Right.
Second is a taxation arbitrage. Right? If you allow taxation benefits in terms of buying and selling for, let's say, a mutual fund product, you should also have the same for, let's say, a PMS product.
Because of course, you're saying at the mutual fund level, fund level transactions don't have capital gains.
Don't have capital gains. Out here, you are basically taxed. And it's a pass-through, which means that the individual needs to file returns and all of that. That is even fine. That's more on operational part. But let's say the capital gains part. Either you tax all of the instruments, same. You are having the AIFs being taxed as the fund level, the Cat 3. Cat 1 and Cat 2 have different rules.
Yeah.
It's basically business pass-through.
Sure.
But that is the basic point of difference. The second is basically scalability. I think evolution of PMSs has a uniqueness in terms of it's not a very vastly scalable product.
Very interesting. Why do you say that?
No. Because see, you are dealing not at the pool level, you are dealing at an individual level, right? It's an individual's portfolio. Now, if you have, let's say, 50,000 clients and your corpus becomes, let's say, 20,000 crores, 30,000 crores, buying and selling becomes that much more challenging.
Right.
Why? Because once you put in the order, the transaction is actually disclosed to the end client at the end of the day, because in a PMS you operate through a power of attorney. Right? So, when the size becomes big, it becomes a humongous issue to operationally manage the buying and selling. That is why I say the plethora of funds will appear in the PMS. The number of PMS platforms will be there. The number of schemes will increase. But the scalability, once you start to reach a particular size, performance becomes an issue.
So you won't have a PMS of 1 lakh crore.
Very difficult. Somebody would be a genius to manage a 1 lakh crore. But you could have an AIF for 1 lakh crore. You could have a mutual fund product, because these are pooled vehicles. You're blind pool vehicles. Here it is not a blind pool vehicle. It's disclosed to the investor, to the market, to the world at large, and operationally it becomes that much of it.
Chalo. Now, this is a great point, right? So, folks, I'm going to do a PMS 101 out here, because Manish has been referring constantly to pooled vehicles. I'm going to ask him to explain pooled vehicle versus a PMS, which is an individual product. Okay, all yours, Manish. How does a PMS operate? Okay, versus how does a mutual fund or even an AIF Cat 3 operate, right? Because as you said, a mutual fund and an AIF Cat 3 at a fundamental level, okay, forget taxation, are pooled vehicles.
Yes.
Okay, whereas a PMS is an individual product.
Correct.
Please explain.
So, basically, when we call something as a blind pool, which means that a structure or a vehicle actually takes in corpus and units are allotted, right? The units basically back the total corpus of that fund. Now, based on the units and the money that you have, you basically buy. But each of the individual members who have subscribed to that fund basically do not know on a day-to-day basis what is being bought and sold.
Correct.
At the end of the month, you give them a NAV. Let's say you put in 10 rupees and the NAV has gone to 12 rupees. That is basically you have gained 20%. But how that gain has come about on a day-to-day basis, you would not be able to understand.
Sure.
So it's a blind pool vehicle where you are not able to see what's happening on a day-to-day basis as far as your investments are concerned. This goes true even for mutual funds. At the end of the month, there is a fact sheet where there is a disclosure of, let's say, a certain number of stocks, the top 10 holdings, or let's say top 50 holdings or something like that. But it's never how the in and out of all the stocks have happened during the month.
You will never know ki in 1 month, the fund manager could have bought 1,000 times and sold 1,000 times.
His churn rates could have been 100%. Or 200%, you would not be, as long as he has generated 20% returns to you, say, I don't care.
And the important point is you are a unit holder. You hold units of the AIF Cat 3 product or a mutual fund. Holding units is fundamentally different from PMS.
Now, PMS, you operate through a power of attorney. It is as good as the individual himself buying and selling the stock. So, he has full knowledge of what is being bought and sold on a daily basis. There is no concept of NAV. If you have put in, let's say, his statement would actually show his initial corpus and losses and profits on each of the individual scripts and totaling to the aggregate loss or profit at any given point in time from his starting of the fund till the time he exits. And based on his buying, you could basically have greater transparency when it comes to fund manager interaction. So if a fund manager says that I'm a buy and hold long-term investor and you see a churn rate of 50-60%,
okay. Will be like
you are answerable, right? But that is not the case when in the case of a PMS or an AIF, you wouldn't even know. So, how the returns have come, whatever the returns have come, the answerability is more in the case of a PMS. So, within the three, I would believe the PMS is the toughest product to manage from the point of view of a fund manager.
Also because it's more transparent. Na? Every month, you know what?
Every day.
Yeah, every
Since
day.
it's a daily liquidity
Kya
product,
baat hai? I didn't know
they,
that.
you are liable to, the client can actually press redemption at any given point. In time.
So folks, what that means is that the charge you pay in a PMS, okay, and there is a charge, by the way, it could be in the form of an annual flat fee,
Fixed
profit
fee,
share,
profit
whatever it is.
sharing, catch up, high watermark.
High watermark, low
anyway.
watermark. So you can actually compare your performance with the fees. You cannot do that in a mutual fund, okay? Other than knowing at an overall level whether this fund has beaten an index or not beaten an index, you will not know anything.
You will never come to know the how part of it. You will only come to know what is visible to you, but how that has happened, that is more possible, is totally possible in the case of a
You
PM.
think the regulator will, you know, is mindful of this, and you think going forward kuch ho sakta hai yahan pe?
See, regulator knows everything.
Okay.
I think they have tried to keep it slightly differentiated. But, it's a conscious effort on their part to keep it differentiated.
Sure.
They want to keep it differentiated from the point of view of the fact that the mutual fund caters to the retail investor. And that's the primary motive, to protect the interests of the retail investors. And the PMS and AIF basically caters to the sophisticated needs of a high net worth individual and an ultra high net worth individual.
Okay.
That's the point of differentiation. The regulator knows and he wants to keep it that way.
What about flows? In general, the conversations you're having with your distributors, with clients that you meet, HNIs, alternate HNIs, at least mid-term, long-term flows coming into PMS specifically, not AIF. PMS specifically?
See, PMS used to see good flows, but over the last 1 year, ever since this, the buyback and the dividend tax, etc., have come about, I think flows in the last 1 year has been specifically been muted. There is a shift of market share between players, but overall flows into the PMS industries have not been that great this year. But that's not to say that over the last many years, flows has been pretty decent. 20% plus sort of a increase in flows happens on a yearly basis, apart from the AUM increase because of market appreciation, so on and so forth. But since the last 1 year, because of the taxation arbitrage and because of the dividends again being taxed at the marginal rate, individual holdings, so on and so forth, there is a preference for people to move more in the case of an AIF as opposed to a PMS.
Okay. But
the growth rates in AIFs have definitely been far higher than the growth of flows into the PMS.
Very interesting, because that's a larger ticket size.
And but still, because ease of operation, tax-free returns, the Cat 3, no hassles. Those are some of the benefits.
Manish, let's get into this now. Rough 6 months. Here we are now, we are in Feb. I think by the time this releases, we'll be somewhere in March. Budget has come and gone. Whatever impact was there has come in. Not the first time we've seen a 10% plus correction happen in the markets post-pandemic. It's happened. It's come and gone. But I want you to talk about the two very obvious things: India's economic growth. How do you look at that? And markets growth.
Yeah. So let me tell you a small story behind the journey during the pandemic and what is happening right now. During the pandemic, lives were getting lost, livelihoods were getting lost. So governments all over the world had to do something. What they did was actually print a lot of currency and infused into the system in the individual economies. India did the same. So fiscal deficit expanded. Due to the fiscal deficit actually expanding, gave a tremendous boost to household consumption because people borrowed and spent. Right? Governments, to create a multiplier in the economy, build roads, railways, defense, a lot of money was put in. All this went through PSUs. PSUs did very well. Banks lent, no provisions, moratoriums. Banks did very well. So all the three pillars of the economy are firing big cylinders. During the pandemic. Consumption, savings, investment, it was going through the roof. Corporate earnings went through the roof. Stock markets did very well. This was so far so good. Suddenly in 2022, when COVID ended, governments in India believed that we did an excess because we swayed from our Fiscal Responsibility and Budget Management Act. Our target was to reach 4%. Currently, we are running at 6%. We have to bring down this back to normal.
Yeah.
They started shrinking the balance sheet. So government started shrinking the balance sheets. Corporates got a benefit from the government in 2019 when corporate tax rate got cut from 32% to 25%. Government anticipated a lot of capex will come through from corporate. That never happened. A little bit of capex here and there happened, but bulk of the capex went in repaying the loans. So corporates were deleveraging, government was deleveraging, only the households were leveraging and spending. So there was an asset price inflation, income did not go up, leverage went up. But nevertheless, government was pumping in a lot of money, corporate earnings growth was coming, multiples were expanding, markets did very well from the lows of the pandemic till about 2024.
Correct.
When suddenly the MFI blew up.
Yeah.
So it came to the light that household is in middle class is in stress due to very high taxes, very high
Debt.
and very high inflation.
And income growth is not happening.
Income growth is not there, savings is not there, right? We are not talking about the 5% of the population. Nothing happens to them, whatever the economic. 500 crore apartments in Bombay and Delhi were flying through the roof. BMWs and Mercedes were selling like hotcakes. So 5% didn't impact. It was the middle income and the base of the pyramid which was getting impacted. Government on its part, was busy in elections. So run up to the elections, then they said that now elections have come, let the new budget come. Then there are monsoons, no spending. We are left with somewhat of a gap in terms of whatever the government had to spend. There is a shortfall. Consumer was in any case very stressed. So all of a sudden the corporate earnings growth came to a standstill this financial year. So double-digit corporate EPS growth on Nifty 50 has come down to single digit. That is the repercussion what we are seeing actually in the marketplace. Somewhat of a 25% EPS growth on Nifty 50 in FY 23-24 has come down to 5% growth.
Oh, that's wow. Okay.
In 24-25. This year ending March, Nifty 50 EPS growth is going to be 5-6%. That's about. So let's look forward. FY 26 and FY 27. Real GDP growth as far as India is concerned is not going to be more than 6.2, 6.3%.
Sure.
Our central bank is saying 6.7%, but now you know that we are in a regime change in the US. The environment is very headwinded as far as all the economies of the world are concerned, thanks to policies being formulated at that level. But 6.2, 6.3, add inflation, you get a nominal GDP growth of 10-11%. EPS growth is not going to be more than 10-11%.
Sure.
In that 10 to 11% sort of a growth, you have to find where the markets can go. Markets will also go up 10 to 11%. So broadly at around 22,000 where you should see the floor. Broadly, I think should not.
We are at 23K right now. So
23, so another 5% down. You have seen a lot of pain. In the euphoria for Modi ji's third term, we took the markets up from 22. You should remember that on the day of the results, market were trading very fair at 22,000. Now in the quest that Modi ji has come for the third term, the euphoric conditions of the market took the markets up from 22,000 to 26,200.
Correct.
26,200.
200, that was a
that euphoria is getting corrected.
Okay.
So at 22,000, from 22,000, you should be looking at a 10% EPS growth. So 10% market growth. In next 1 year, you should be closer to 25,000 on the Nifty.
Right.
Within that, a lot of churn. Mid caps and small caps basically went through a stratosphere thanks to retail investor. During the pandemic, everybody was sitting at home. And because a lot of money was being put in by the government, a lot of corporate growth was coming. Valuations were given, multiples were given. That is correct. So that is what is happening.
I'll come to the small, mid cap, large cap later. I just wanted to take one last, opinion from you on the economy. You basically think this is a cyclical adjustment. This from pandemic to post-pandemic, the leveraging and deleveraging of household balance sheets, the slowdown in economy, and now the cuts in interest rate which have already started. It's cyclical. मतलब ऐसा कुछ 6.7 से 4% growth का तो थोड़ा
हाँ वो नहीं है. But I think 3 pillars of the economy: consumption, savings, investment. Government in the last 3-4 years have focused on investment. this budget, the government has shifted the pendulum away from investments to consumption.
Yeah. You know,
Put money in the hands of the consumer who is very stressed,
uh,
and they are the vote bank. So you have to win the rest four states also.
yeah.
So they have to be appeased, and so consumption is to be given preference. Investment, 10 lakh crore, 10 lakh crores, beyond that is very difficult for the government to spend because of the inavailability of projects and so on and so forth, revenue collection, so on and so forth. You can't increase you have to act within the constraint of the fiscal deficit, which is targeted at 4.5%. And for a 6% growth, you should not be building in revenue growth of more than 10%.
Sure.
So if you do your maths, this 10-11 lakh crores is what the investment side of the balance sheet will look like. You have to give a lot of money to the consumer.
Yeah.
They have foregone 1 lakh crore. Right, that will create a multiplier of 5 lakh crore on the consumption side. So the pendulum has shifted away from investment to consumption. But mind you, India is still one of the highest growth rate countries in the world. We don't know what's going to happen tomorrow, thanks to the tariff regime globally. India could also be disadvantaged along with other emerging markets. Because dollar is going to be the most strong currency in the world, but that could impact a lot of they could raise a lot of geopolitical issues.
You know, my only concern when I heard you saying in this very simple but very detailed way was that in 2019 when the government cut corporate tax rates 32 to 25% with the hope that capping will happen, cappings तो
नहीं हुआ.
Okay, जितना हुआ जिन्होंने करना था कर लिया.
थोड़ा बहुत हुआ. That's about it.
I just hope that now when these guys have cut the tax rate or whatever they have done, okay, with the hope that consumption will pick up. I don't know if it will.
No, so there will be stages according to me. First, the deleverage is going to come down. Then, the next year, the same savings is going to be there because we are not building in any major growth in per capita income in the next 1 year or so. Because so it's going to happen in stages. First, deleveraging will happen, then the spend will happen.
I don't think people understand this deleveraging point simply because if एक घर के अंदर अगर आपको ज़्यादा पैसा है, see your income hasn't increased and your expenses haven't gone down, your tax has gone down, which means that you have more disposable income.
Yes.
The first thing you will do is you will repay your loan.
Yes.
I hope
personal loan, credit card, those bills will be settled first. Then the next month's salary, you will say ki, roti and kapda has been taken care of. Let's spend something more. Let's say a two-wheeler or discretionary, housing, Medicare. All those things will be catered to the next.
Sure. Let's hope that happens. Okay, sectors, themes.
Yeah. So I think, rupee depreciation, because it's about dollar strength, and obviously if dollar is becoming strong, rupee is likely to be weak. We already seen rupee depreciate from 82 rupees 90 paisa in February 24 to yesterday's level of 87.95.
6 rupees in
1 year.
6 rupees in 1 year on a base of 82. I don't think I have seen that in a very long time. Like एक ज़माने में क्या था कि 5% assume था पर फिर 2% हो गया.
तो basically rupee is weakening. That will give impetus to export oriented sectors. India has its right to win in IT and pharma. So these are two sectors where I think there will be a lot of value that will get created. Second, I think banks, because RBI has cut rates, lag effect will be felt on your credit growth because people will be incentivized to take more loans because rates have come down, housing loans, mortgages and all that. So banks will likely do well. Valuations are extremely comfortable because the budget has given a lot of impetus on consumption, discretionary consumption, not staples, because GST, if it had been cut, it would have benefited the staples more. But it has been corporate income tax which has been reduced. So basically out of 7.5 crore people who pay taxes, 6 crore people have income less than 12 lakhs. These 6 crore people are likely to benefit. This is going to benefit more consumer discretionary.
Correct, yeah.
Insurance has seen very beaten down valuations. And now what we are seeing is basically all the negative impact of the taxation benefit going away. 80C. Deduction, because under the new taxation rules, you don't have any deduction. So bare bone, this is the growth of the insurance sector. You are getting it at very mouth-watering valuations. And the last but not the least is basically a financial sector leading the real sector as far as India is concerned. And within the financial sector, the tilt is happening away from debt to equity. So I think equities and equity-related platforms over the next 5 years, we're not talking about the very recent weaknesses, because they are duopolies and the runaway for growth in India's journey from 4 trillion to 16 trillion in the next 12 years is a very big possibility, give or take a few $trillion here and there. And capital market intermediaries are very high entry barrier businesses. They are not very easy to replicate due to compliances and technology. Big will only get big. These are some of the areas where I think there could be money.
Exchanges, AMCs, things like that.
Yeah, absolutely. Exchanges, RTAs, depositories, repositories.
And now they are all there. एक ज़माने में तो ये भी नहीं था.
Wealth management platform, the AMCs, yeah.
Okay, favorite topic. Of course, I'm talking to a PMS person who doesn't even have, who doesn't differentiate between large, mid and small, but you mentioned that, right?
Yeah.
And maybe you would be in a happier place because you don't have much to do with all this thing. Mutual fund industry has to grapple with, having done too many NFOs in certain sectors and themes. What's happening?
So basically, it's reversion to the mean. Literally speaking, you overdid. Obviously, beaten down valuations during the COVID was a pure recipe that small caps will do better. Because when the growth comes, it's a law of small numbers. In the law of small numbers, when you deal with small numbers, the growth appears exaggerated in percentage terms. That gave the market cap increase over the last 4 years. But anecdotally, if you look at numbers, in every major high in the market, let's say 2007 Lehman crisis or Asian crisis or COVID, you actually never saw these sort of valuations for mid and small caps. So it has corrected.
Okay.
But to paint and say that every mid and small cap is basically very overvalued is not correct.
Sure.
I'll tell you why. Because if you just see the Nifty 50 next.
Nifty next 50, correct. Yeah.
Those are large caps.
Yeah.
In the month of January, they have also tanked 7%. Nifty 50 has only fallen 0.5%. So just to say that large caps will outperform and mid and small caps will underperform is not correct.
Sure.
Because Nifty 50 next is also large cap. They have also fallen 7% in the month of January. So it's about pick and choose. Broadly speaking, if you are buying mid and small caps where PEG, price earning growth multiple is between 1 and 1.5, should broadly be fine.
Okay.
But if you are buying 3 PEG, 4 PEG, 5 PEG in the mid and small, it's a recipe for disaster. Everybody knows that. So I am not in the camp who believes that small caps and mid caps are untouchable, only large caps. I don't think that works that way.
Sure.
This sort of panic in the markets gives you the best opportunity. Mid and small caps are investable products for next 3-5 years. These are not basically a 1-year product. And the amount of money that can be made if you buy at panic levels in the mid and small cap space is not funny. We have seen that umpteen number of times. We have seen that latest during COVID times, the amount of wealth that has got. It will again repeat.
Yeah. I'm just wondering, so, if you're sitting on fresh flows that come in broadly, first of all, I don't think you differentiate between the three. For you, an opportunity is an opportunity.
Multi-cap is the best way.
Okay.
Large cap gives you the stability. Mid and small cap will give you the growth. Have your time horizon of 3 to 5 years.
As simple as it can be.
Broadly, you should be done.
Fantastic. So, just one, AI.
Yeah.
Any, is the market underestimating, overestimating, has even understood कि भाई ये क्या हो रहा है यहाँ पे?
See, AI is going to, make lives of individuals even better, as is the case with any technology revolution. Why does a technology revolution happen? Just to make our lives more comfortable.
Sure.
So AI will give us a lot more information. It will make our lives easier when it comes to the quest for knowing more things. So even in the investment horizon, a lot of data will be analyzed by machines, will be available to you at the touch of a button, so on and so forth. So obviously, India is never a part of a major technology revolution, as is the case with Y2K or let's say your iPhone or cloud computing. It all originates in the US, right? But India adapts itself around the new technology in a very beautiful way. So there hasn't been too many used cases when it comes to, let's say, an AI in the current environment, but there will be. Right? You suddenly saw a number of deals that are starting to come with GCCs, which is Global Capability Centers, and even third-party IT vendors. The number of deals incorporating AI are starting to move up. So the amount of investments that have gone into AI, the risk is to reward, or let's say input is to output ratio when it comes to costs and benefits, are still skewed towards costs. But as is the case with any technology revolution, it picks up after a cost gradient. When the cost starts to fall, the adaptability goes up. And India, as is always the case, makes itself relevant around the new technology. The hope is that India, in this case, also will make itself relevant around the new technology. It's a wait and watch. But a lot of use cases, even in the investment field arena, creates a lot of investable opportunities within the startup space, within the semiconductors, and a lot of things which India is talking about. Yeah, there will be opportunities.
Okay. Last two questions. First is, let's just wrap everything up. If you can help our audience understand how to choose a PMS. Right, that is relevant to them. Right, someone who's investing in a PMS for the very first time, what would be your advice to him on how to choose his investment performance, alpha, beta, whatever it is, the only thing, or is there more to it?
No, so I think first of all, when to choose a PMS is the person manning that product, or let's say who is the person behind that product. What is his track record? Those are two major important things. And when you interview or question the fund manager, basically you have to be in sync with how the fund manager thinks.
Okay.
And then you introspect that whether his thinking syncs with your temperament when it comes to investments.
Very interesting. Temperament. You use the word
temperament,
which is very important.
And that can only be done through introspection by the investor.
Okay.
Somebody who is a risk taker, will go with that style of investing. A lot of churn, doesn't matter, profit or loss. At the end of the day, what is? There are certain very risk-averse investors, who says buy and hold, wealth creation through stock picking, but not too much of churn, because that is not investing, that is trading. It will all come out when you speak to the fund manager, right? So introspection and questioning of the fund manager is a must. Then comes the track record, because past performance, though it is no guide to future performance, but it somewhat is an indication of how things could be. So given that competition in the PMS space has actually increased multifold, it pays to stay with experienced fund managers, because they have seen through cycles, because not many new managers have seen through cycles. It is very good to come in a bull market, and I think the latest bull market has evolved during the COVID times, and we have not seen a down cycle as yet. So many new managers will not see the down cycle. They'll fall apart. So I think again out here is basically tenacity, mental tenacity of the fund manager as to how he deals with crisis moments, whether he sticks around to his thesis or he throws in the towel, determines a lot what is going to happen to your capital, because they say that markets will always have a propensity to go against you.
Sure.
Particularly, they will test you at all points in time. And a weak-hearted fund manager will likely lose capital in crisis moments. So that is one. And the second is basically your liquidity. These are attributes of performance, basically up capture, down capture, alpha, beta, sharp ratio, trainer, how much of risk you are taking per unit of return, so on and so forth. Those are standardized, templatized. But it's basically this thinking, what he's saying, whether he's doing that in his portfolio or whether he's just saying, doing something else. Your heart is where your mouth is, or your mouth is where your heart is to be checked. That is the
and staying the course, what do you think about it? I mean, how often should I review my PMS? क्या होता है कि अभी मजा नहीं आया एक साल में. So I think it's better if you just lock into that fund manager, temperament matches, and then you just...
I think a fund manager should be given at least 3 years.
Okay.
Because I think this is a sophisticated product, nuanced product for an HNI who wants to create wealth. And wealth creation only happens when you stay with a particular manager for at least a period of 3 years, if not more. The longer you stay, the better are your chances of making wealth. I'm not talking return or income. Income is differentiated from wealth. If you want to create wealth through equities, and through a PMS, I think you stay a course of at least 3 years.
Thank you. I think that's valuable advice. Manish, our last question, standard questions to all our guests who come in out here. Any book recommendations, classic books, anything you're reading or your favorite books?
So, platform businesses have become the rage. So, you just go through this new book, brilliant book, that is basically Platform Revolution.
Okay.
This is the new book that I'm reading. The Nikas of the world and the Zomatos of the world, these are Paytms of the world, these are platforms. How do they work in the real world? I think you should look
So
at
interesting, right? Because I can't think of any company younger than Zomato that entered the benchmark. I think like even if I go back in my history, it used to be, family businesses, banks and all who've been there for 30, 40, 50 years. Ye log ne to
कर दिया.
Yeah, very interesting. Maybe that's the future.
No, because he basically, it was, the story behind Zomato, right?
Yeah.
So,
Dipinder,
Dipinder, IIT, mess, didn't have any food to eat in the evening.
It's just that, the failure rate of this business is so high.
Yeah.
If you can find that one
high
person
entry
who...
barriers.
Yeah, that's what.
Very high entry.
And on that note, that is a wrap on this episode of Paisa Vaisa. My guest, Manish Sonthalia, Director and CIO, MK Investment Managers. Manish, thank you so much for doing this for our audience.
Pleasure to be on the show. Thank you so
Fantastic.
much.